But how much can you really afford to pay for an acquisition, and how do you determine kind of what the parameters are of how much you can afford to pay? And I'm going to let Pat go last because he has the banking background. So go ahead, Jim. Why don't you go first on that question?
Sure. When you're looking at financing and acquisition, there's multiple ways to finance it. You may have built up a fair amount of cash in your balance sheet that you can use to finance all or a significant portion of the acquisition, depending on its relative size. Depending on the type of company you are, you may have assets that you can leverage and borrow against if you haven't already, and the company you're acquiring may also have assets that you can use to support a debt to help finance the transaction. So when you're thinking about the deal, you can look at sort of the combined businesses and what debt they may be able to support on a combined basis, not just your own company's borrowing capacity. And then there's the cash flows of the business. You want to think about your cash flows, and then what cash flows may be gained through the acquisition, and how those do one and one make three when the businesses are combined. I think it's prudent, particularly if it's the first acquisition, to be conservative in the amount of borrowings you may take on board to support an acquisition. Again, things don't always go as planned, and therefore you don't want to be over leveraged and constrain or hurt your core business that is supporting the enterprise. But again, leverage or debt is probably the most common form of financing to support acquisitions. There are times when you may you need additional equity, and there's different forms of financing, subordinated debt and other types of financing, or you may go find a non-controlling equity partner to support an acquisition, if that makes sense. But there are a variety of banks, non-bank lenders, non-control equity investors out there, a variety of capital sources for middle market businesses that can support it. But again, I think it's particularly out of the gate, you want to be prudent and conservative and as you embark on your acquisition strategy.
Go ahead, Kevin.
Okay. I guess what we look at is how much we can afford to pay based on our banking loan. I mean, bank financing is the cheapest way to go. We never give up control. We don't like to have another partner involved in the process. So I think taking a look at the combined cash flows going forward gives you an idea of what you can afford. Unfortunately, when you deal with rep companies, with brokers, invariably you'll look at their waterfall and it'll look like a hockey stick, if you will. So, this year we're here, next year we're up here. And if you rely on that, you tend to overcommit the amount of return you're going to get to support your cash flow. So.
Yeah, I mean, I would agree with both these guys. I mean, I think the number one thing is to be conservative in the way you look at it. Whenever we look at transactions and we see their projections, obviously their projections always going to be, pretty flowery, and we like to at least try to put some realism into the projection and look at as if, this company say did X, at closing year. Can we do this if a company just stays flat? And with our company or as a standalone, does this work? We never try to factor in 15-20% growth that a lot of these projections say, because that's when you get in trouble, and that's when you start to over-lever. And if you're over-levered and you were banking on 20% growth, that's when you can really get into some bad trouble. And as it comes to bank financing, the lower you get in the size spectrum, truly the harder it is to get senior financing for M&A transactions. A lot of times what they'll do is they'll rely more, as they noted prior, on asset value, and you have a hard time getting smaller banks comfortable with cash flow type of lending. So one of the big things with that, especially if it's your first deal, is it's one of the good reasons why you want to foster your relationship with your bank. Because if you have a good solid relationship with your existing bank and you've shown a track record with them, they'll be more apt to support you in a transaction like this, particularly if it's your first one, as opposed to trying to go out to the market. You have no banking relationships. You're now going and you're getting 5 different banks to come in and look at your first acquisition, and you're asking them to give you 2.5 times leverage and a $4 million airball on a deal. Well, they're not going to be all that comfortable doing that, or they're going to ask you to personally put some things up there to support it, or do some other things that might leave you a little bit uncomfortable with the transaction. So it's vital to, even when you don't think the bank is necessary, it's vital for you to foster your relationship there with them, especially if at some point in the future you have a plan to do acquisitions. Talk to your bank about that early and find out if they would be supportive of you, and if they would not be, then maybe at that point in time you want to find somebody else.
Just to add on that, I think making sure you're having open dialogue with your bank and other professional services partners is important. Even a relatively small acquisition that may not require a lot of bank financing could impact bank covenants and things like that you need to be aware of.
Yeah.
So it's important to just keep them in the loop and make sure you've thought of those types of scenarios when you're looking at acquisition. One source of financing that's commonly used in lower middle market deals, or I don't know if commonly, but you do see it in lower middle market deals, is seller finance. So oftentimes the seller of the business, or the business owner that's selling, may agree to be effectively a lender into the transaction, and they may, if there's a gap there, or there's a financing gap, they might be willing to be a note holder and get paid some sort of coupon. They're behind maybe the bank debt, subordinate to the bank debt in terms of liquidity, but again, they can be a source of financing to finance a transaction as well, particularly for deals that are on the lower end of the market where banks sort of tap out at a certain leverage level, and there's still a little bit of a gap to fill.